The next question we would like to review is fans. It's a Section B type question. It's the scenario-based objective test questions. So we will cover fans question 1 to question 3. So here is the background information. For Section B, I would like to say you have to read through the materials first to understand what is the requirement, and then coming to each questions or each small type questions, so that you can understand the background information first before handling each requirement. So let's read through it, and then we'll go to in the details. Okay, so for fans, it's a question about the NPV, or not only NPV, it's about the investment appraisal. It's about investment appraisal. We'll go through the payback. Okay, we'll go through the return on capital employed, and we will have one question asking about the detailed definitions. So we would like to go through a lot of things about the investment appraisal topic. And for these questions, here the information is okay. The initial investment is 3.9 million, and then we have the net operating cash flows for each year, and also the square value of the project. And the background information here saying that the investment project will increase shareholder wealth. Okay, it's very important for you to answer the questions like shareholder wealth, the financial management function. Even we will not go through today, but bear in mind these questions are good questions for you to practice for shareholder for financial management function. And the target is to achieve return on capital employed at or greater than 15%. And also the evaluation criteria, including payback, also ROI, return on capital employed, ROCE methods. Shareholders have recently, okay, here the point is, shareholders have recently criticized the directors for using these investment appraisal methods, claiming the company should use the academically preferred net present value method. Okay, and here is one more information for you to answer the financial management functions. For example, here is talk about the remuneration package, how to reward those directors. Okay, here is the target is to achieve the return on capital employed greater than 15%, and does not include any share option scheme. So here is for you to answer the fourth or the fifth questions here. And we are focusing on the first part, okay? The first part about the investment appraisal. So first, the requirement is asking what is the payback period of the investment project. So payback period, okay, means the cash flow to recover initial investment, right? Here is the payback, the calculation should be focused on. And we look at the net cash flow pattern, first year, second year, third year, and fourth year. And also we know the initial investment is 3.9 million. So we can do the simple calculation. Here is the cash flow, and each year. At the beginning, we have the cash outflow, 3.9 million. Okay, and in the first year, we have the cash inflow, which is 1,200. Is 1.2 million, and then how much debt we need to recover in next period is 2.7 million. So in second year, which we will have cash inflow is 1.5 million. So the balance to go is 1.2 million. The gap we have to be closed in the third year. And in the third year, okay, it's good. We have the cash inflow at 1.6 million. So we know that the payback period is between the second and third year. So it's 2 years the payback period plus assuming the cash flow is evenly distributed in a year. So we have the gap by the end of second year, we have the gap of 1,200 is divided by 1,600, okay, times 12 months, or you just ignore it, okay. So it's when you use the calculator to check the calculation, is 2.75 year or 2 years and 9 months. So the answer is A, right? It's A. So the next requirement, the second requirement asking, is based on the average investment method. What's the return on capital employed of the investment project? To recall, what is average investment method on the ROCE, on the return on capital employed? Okay, is the average profit divided by average investment. Okay, first of all, we need to find out what is average profit. Okay, we have 4 years operations. We have the net cash flow. In the first year, it's 1.2 million. Okay, or 1.2 million means, and in the second year, we have 1.5 million net cash flow or net cash inflow. In the third year, we have 1 million and 600,000. In the fourth year, we have 1 million and 580,000 net cash flow or net cash inflow. Because for the profit, okay, for the profit, we have to take out the depreciation or include the depreciation in the profit calculation. So here, the net cash flow doesn't include any depreciation charge. We have to put back the depreciation charge. Depreciation charge in the first year is $950. Okay, how to get $950? Because the investment is $3.9 million, and we have 4th year. By the end of the investment period, what's the scrap value? It's 100,000. So minus 100,000 divided by 4 is 950,000 on the annual depreciation, assuming a straight line method is used. So every year we have to take out 950 in the profit calculation. So in every year we got the profit figures. Okay, which is in the first year is 250. In the second year it's 550. In the third year it's 650, and in the fourth year it's 630. So what's the average profit in the period in this 4 years? The average profit is 520. Okay. So move on is an average investment. Is the initial investment plus any scrap value. Okay, take this average, which is divided by 2. Then you got how much? Here is 3.9 million plus 100,000 divided by 2, which is 2 million, right? So we got the average profit is 520 divided by 2 million times 100%. So the answer is 26%. So it's B. Okay, B is the correct answer for this average investment asset calculation. All right. So first of all, it's very important for you to understand the return on capital employed formula here. So move to the next one. The third part of fence. Here we have 4 statements, and please find out which statement is correct. Okay, so one by one. First of all, the option A, the return on capital employed method considers time value of money. Is it correct? Okay, it seems not. It's not correct. Why? Because when we consider the time value of money, okay, we have a discount factor. Okay, but for return on capital employed, we don't consider any discount factor. We don't consider any future. It's not about the future cash flow to consider. So it's not. It doesn't consider the time value of money for the return on capital employed, because it's the only discuss about the historical rate of return, as we share in the second question here. Okay, our return on capital employed is only consider the historic, or not historical, only consider the average profit on the average profit only. It's not about the time value. It's not about the time value. It's about the average profit for a particular period of time. It's not about the time value of each year. For the cash flow in a bit year closer to now, okay, we have a higher weighted, but for the cash flow far away from now, we have the weighting will be lower. Okay, it's not like this case, so it's not about time value of money. And for B, it's also about the return on capital employed. Return on capital must be greater than the cost of equity if a project is to be accepted. Is there any relation between those return on capital employed and cost of equity. Okay, no. Okay, for cost of equity, we don't. It's not about. It's not the case. Okay, it's not the case. It's not the case whether it's greater or smaller on the cost of equity. Okay, it's not the case. So it doesn't matter for. It's pointless to compare these two, the return on capital and the cost of equity. And for C, riskier projects should be evaluated with longer payback periods. It's also wrong. It is also wrong. Because for payback, it doesn't consider any profitability. Okay, it is only considers when is your initial investments will be recovered. So in this case, no matter if the project is risky or not, in the payback method, it doesn't consider any risk. Okay, it doesn't consider any risk in the payback period. So no matter it's longer or shorter, it's only considered about whether the initial investment can be recovered. And for D, it's correct. Because payback period, yes, it ignores the timing of cash flows within the payback period. It only considers about when will be the initial investment recovered. Okay, so D is the correct answer for this question. All right. So I hope you understand for these three questions in this objective scenario-based objective test questions.